business in. It's people say, oh, it's great landlord. I mean, a landlord-friendly state. Yeah, it's fantastic. Yeah, you can kick somebody out. You can have somebody evicted in 12 days. 12 days in Texas. Lawyers don't even take on the cases because there's no money in it. You just go down and you file a form, $25. 12 days later, the sheriff shows up and cleans the guy out and puts everything out on the curb. And that's it. Sounds good, right? My appliances in Texas all had legs. Okay, I can go on, but I mean, I gotta move on. Watch the time. Oh, it's unbelievable. I hate Texas. All right. Go ahead.
So which are the good states?
Well, no, I can't answer that now. No, that's got to take me too long. Okay, appreciation. This is another way to make money. Appreciation. It's called, and what we do, and you're going to find out about it, the power of the cap rate. You drive the net operating income. When you increase the net operating income, that's called forced appreciation. See, the thing about multifamily is it's all about the cash flow. It's not about the market. The market does have a role to play in it, but it's not like a single family business where you've got, what the house next door to me sell for? Oh, then that's what my house is worth. Here in the multifamily business, we drive appreciation, forced appreciation, by driving the net operating income higher. That's how we make money, increasing the value of the asset. You'll see how that works in just a moment. This is how millionaires are made. Number 3, mortgage pay down. Remember how I asked the question, how many people had 100 people, over 100 people putting money into their retirement plan every single month? Well, if you have an amortizing loan and you're paying off that note every single month, you're having somebody put money into your retirement. You take out a 20-year loan, with $1 million loan, and you have your tenants paying it off every single month for you. At the end of 20 years, you got $1 million asset free and clear. How much did you put in for that? Nothing. You had a bunch of people paying for it. That's another way. Does a subway guy make money this way? No. Only multifamily. Property management. Pay yourself first, guys. And I keep saying guys, but there are ladies here too, so just flow with me here. Remember that 116 unit property? I didn't make a dime. If I ran the property management company and I took 5% off the top of every dollar collected, am I making money this month? Every single month. When I owned the property management company, I could quit my job because I was getting the same amount of pay. That's my salary. I could pay tuitions, I could pay all my home expenses because now I ran the business. And believe me, you're going to do it anyway. There's no reason why, you should be paying a third party to be doing this. You're doing it anyway. You're managing the manager. Okay, so why do I need to manage the manager? Isn't that what he's supposed to be doing? Why am I paying him 5% to do that? When you get up to, the numbers, it's usually around 125 to 150 units. When you get to that level, that's when you can really quit your job. And that's if you do it the right way, and you double what you own every single year, and about the third year, you can quit your job. That's when it works. All right, 4th one, acquisition or disposition fee. Okay. So I bought a property for $7.5 million, okay? And I syndicated the deal. So I went out and raised about $2.5 million from, investors. And we all came together and I put the whole deal together. And in the offering memorandum, in the private placement memorandum documents, I declared to everyone that I was taking a 3% acquisition fee. So on 3% acquisition fee on a $7.5 million property, what check did I get at the closing table? $210,000. And as we said, Lordy, Lordy, there'll be chitlins for dinner, as we say. But that's how it works. The Subway franchise guy, can he do that? No. But when you're syndicating deals, and listen, it takes just as much work to sell a property too. If you build into that private placement memorandum that you're disclosing it, that you're taking a disposition fee, then you can take money in too. And I say 3%, it can be 2%, it could be 5%. I've seen some guys do 5%. That's, there was one guru that did his own fund, and he kept a 5% acquisition fee. And people bought into his fund. And what that tells me is that his investors weren't really that sophisticated if they're willing to spend 5% on an acquisition fee. 3% on a, smaller size property. As the properties get bigger, you're looking at a lower number. All right? Now, okay, owning now, I am going to start to change the way you, am I too close? How am I doing?
You're doing good. You're doing good. Looking good.
Okay, really?
Mm-hmm. Yeah.
Really, like that? Yeah, okay.
It's good.
I'm not believing them. I don't believe a word he's telling me. So, okay, I want to shift your paradigm. I want you to make you think about multifamily property differently, all right? Owning income-producing property is not about owning real estate. Real estate is nothing more than the factory that produces a product. Okay? Think about it that way. Take a look at Mary. Mary's got this property that was built in 1986, 100 units in a secondary market. It's got 31 bedrooms and 72 bedrooms, okay? Now, this is a really nice property. Look at it. Individually metered, separate entrances, pitched roofs. This property is exactly what I look for in a property. Built in 1986, starting to get a little long in the tooth. 90s and better might be a little bit easier to own. It's in a secondary market. Okay, secondary market. I use that example of the markets based upon airports, because I'm a pilot, so I think about everything in the as far as airports go. If the market has an international airport, that's a primary market. If it has a regional airport, that's a secondary market. If it has a non-towered field where the pilots are just flying around talking to each other, that's a tertiary market, okay? So that's just my quick little rule of thumb to make you think about where you are, what type of properties you should be looking for. Primary markets are where all the big money goes, where all the Class A properties, all the foreign dollars go into primary markets. Chinese money, they don't even try to sell them on Wichita, because they don't want their money in Wichita. They want it in LA, they want it in Honolulu, they want it in New York City. That's a primary market. Okay? Now this place, Santa Barbara, I guess I don't know it well enough. I mean, I guess they call it an international airport.
They call it the home of the newlywed and the nearly dead.
Oh, is that right? Well, I would say that's a secondary market. That sounds like a secondary market to me. Okay, so Mary's property. Now look at, right next door to Mary is Bob. He's got the exact same property. Look at it. And the fact that they're across the street means nothing in the fact of the location. Bob's and Mary's. So my question to you is, which property is more valuable, Bob's or Mary's? Which one generates more what? Well, no, they're real estate. It's real estate. They're right next door to each other. So that's all we care about, right? Because it's real estate. What do you care about? You care about what? Income. You agree? What is your name? Is Eric? Eric. Hey, do I know you?
Yes, you do.
I thought I did. How you doing?
I'm very well.
Good. Nice to see you. Geez, I get like old home day here. I got Calvin here, and all these people come to see me talk all the time. Because I'm like the Don Rickles of multifamily. Do you know what that means? You do. You don't know. She doesn't know. She doesn't know. I was doing this podcast with this guy. I've never seen him before, but I get asked to be on all these podcasts. I say yes to every podcast. I'm starting my own podcast. I've already got like 12 episodes in the can. That's lingo for podcast talk. And so I've been waiting. I don't know what's taking it forever to come out, but it hasn't come out yet. And so I was doing this podcast with this one guy, and he says, so if I came to one of your sessions, what's going to be like? I said, well, I'm like the Don Rickles of multifamily. I say whatever I want. And he goes, and he just kind of stares at me. And I said, you don't know who Don Rickles is, do you? And I get to see him Googling it while he was on the phone. Oh my God, no, please. All right, so which one is more valuable? He says the cash flow. Joel says the cash flow. How many people agree with Joel? Yeah, because let me give you one little bit more information on these two properties, all right? Mary's is 100% occupied, but Bob's is 100% vacant. Which one do we want to buy? Mary's? How many people want to buy Bob's?
I do.
Exactly. We want to buy Bob's. We're investors. We don't pay retail. We look for these value-add things. This is where the money is made, and I'm going to show you in a moment. One of my students is about to be almost $2 million richer in the next 2 years because of the power of the cap rate, because we look for Bob's properties. Okay? This is where the millionaires get made. All right, what product do we sell in this business? What product do we sell? What has to be sold before any money exchanges hands? What's the very first thing?
Cap rate.
No, cap rate? No. What's the product? What's the item? What's the thing?
Housing.
Housing? But give me the specific. What?
Tenanting.
Tenants? What do we get from tenants?
Right.
Leases.
Income.
Leases. Nothing happens until we have a contract. This is a contract business. Hey, Maria, can I get some water, please? Thanks. This is a contract business. We sell contracts. Just like wholesaling. You know, wholesaling is nothing really more than pushing paper across the table. You never really take possession of the property, you just sell a piece of paper. That's how you wholesale. I want you to think about multifamily the same way. And when you talk, thank you very much. When you talk to a property manager and you talk to the leasing agents, they actually talk in these terms. How many leases did you sell this weekend? That's what they say. Because that's what this business is. We sell leases. Okay. This is where I don't want to lose anybody, but I'm going to start talking algebra. But this is what it's all about right here. This is about the cap rate. I'm going to teach you how multifamily is valued, and then I'm going to use real life examples so you get it. When you walk out of here today, you will understand when you drive down the street and you see a multifamily property, you will know why that owner is in clover. Because he has a sweetheart of a deal. And it's all because of how we value multifamily. Here it goes. And this is universal. This isn't just up in Boston. This is across the whole country. This is how we value multifamily. The first variable that I want you to understand is what's called the net operating income, the NOI. Net operating income, not the net ordinary income. When you get a multifamily financial statement and you look down the bottom at the income minus the expenses and it says net ordinary income, you know they're using a QuickBooks program to manage their property. It's not a multifamily property. It's not a real estate software accounting program. So I want you to remember, it's the net operating income. Now, what makes up the net operating income? Very simple. It's the income less the expenses equals the net operating income. Oh, that's easy, right? Well, you're going to see in a moment how the income and the expenses can be manipulated. Because obviously the guy selling the property wants to make his NOI look phenomenal, because that's part of what we value. So he's going to try to make his NOI look really good. And what is my job with my students? To make sure you don't get screwed, okay? But two things are left out of this equation. The first one is it doesn't include mortgage payments, okay? It does not include mortgage payments. Well, why not? That's an expense, isn't it? Okay, think about it this way. We've got Sudi right over here. He's going to buy Mary's property. Sudi, look at the guy. Looks like he doesn't have a pot to piss in, right? He can't afford to buy Bob's property. He's going to finance the thing at 100%. No money down, because he doesn't have any money. Now look at this guy over here. He looks like he's got the first dime he ever made. He doesn't believe in banks. Actually, he doesn't have the first dime he ever made. He bought a wallet with it. Okay, so he is going to buy this property all cash. Which is the better investment? Okay, now Calvin says that Sudi's is the best one. Now why, Calvin?
Better return on your investment.
Okay, because the cash on cash return is calculated by the denominator being the amount of money you put into it. If you put 0 into it, what's his return going to be? Infinity. So if he makes $1 on that property, and you make $1 on that property, who's got the better return? Sudi does, right. But remember, What we're trying to calculate right now is the net operating income. We want to know how that property performs as a property, not as an investment. So we want to take that whole debt issue off the table. And we want to look at these properties as if none of them have any financing issues. They're all on level playing field. So, the reason why we do that is because regardless of whether you own it or whether you own it, that little old lady in Unit 2B who's been there for 20 years is going to pay her rent on time every single month, whether it's financed at 100% or whether there's no debt on it whatsoever. So we just look at the operating expenses, okay? Forget the debt. So in the calculations for the NOI, forget the mortgage. It doesn't get included. The other thing that doesn't get included are the capital expenditures. Remember I told you before about that reserve replacement with the bank? That goes towards paying off the capital expenditures. All right, so those capital expenditures, they don't get included in the NOI either. We don't care about those. Now, capital expenditures are items that have been excluded from the repair and maintenance line item. Repairs and maintenance are operating expenses. Typically considered to be of a capital nature and are subject to amortization or depreciation and that are not anticipated as part of the capital expenditures or the replacement reserve. Okay, so let me ask you something. Paint, CapEx or not CapEx? Not CapEx? How many lawyers in the room? Correct answer is the lawyer answer. Well, it depends. Okay? Paint, interior paint, that's an operating expense. Exterior paint is a CapEx. Parking lot, CapEx or operating? CapEx. Payroll, operating or CapEx?
Operating.
Okay, so what happens is as you start to learn this business, you know right away which items are CapEx and which items are operating expenses. All right? I'm not asking you to know it now, but I just want you to always understand that. We're trying to calculate out the NOI. So for instance, if an owner has a big repair and maintenance budget, or he's spending a lot of money on having to repair that property all the time, and he's looking to sell the property, what he's going to do is take those R&M expenses and put them into CapEx. So his NOI goes up. He's just bamboozled you. Okay? And I'll show you who gets hurt by that bamboozling. All right. Now, the next item is the price. The next variable in this 3-variable equation is the price. Now remember about algebra. You got 2 variables, you can solve for the third. The next variable is the price. Oh, that's easy, right? No. But what price? Now, you might be thinking to yourself, well, Charlie, the price is the price. No. One price is the asking price. I call that the biggest lie. Okay? When we talk, I have students that come to me and say, Charlie, I keep working up these numbers. I'm always 25% below the asking price. What should I do? What do you think I tell them? What do you say, Calvin? Walk?
No.
Oh, you said walk. Calvin, yeah, nice try. Exactly. It sounded like it came from you.
No, and you just put in the offer at the lower price.
You make the offer that works for you, and then move on to the next one. I don't care. The asking price is the biggest lie. That's not going to stop me. The only thing you can control in this business is making offers. That's the only thing you can control. You can't control getting the offer accepted. That's somebody else's business. You can't approve whether the bank is going to approve the loan. That's the bank. The only thing you can physically control in your business is making offers. All right, that's the offer price. That's what we just said, the one that works for us. And the final third price is the purchase price. So as you can see, depending upon which one of these prices we're talking about, that's going to impact the equation, the 3-variable equation. All right, next one. Oh, the cap rate. Okay, now this is where people start to get a little like, oh, now we're going to start talking high finance. Okay, let me explain to you what the cap rate is. Look how wishy-washy this explanation is. It's a rate of return on a real estate investment property based on the expected income that the property will generate. Cap rate is used to estimate the investor's potential return on his investment. Basically what we're doing here, guys, is we've got this investment, and we need some type of a tool to be able to compare this investment to other investments. Because we want to get grandma's money into this deal. Grandma's got a $100,000 CD maturing, and she can keep it with Bank of America, or she can go put it into our property. But we need some type of a way that we can calculate, look at the two of them on the same playing field. This is a very simplistic explanation of cap rate. But I'm going with it. Because I look at some of these faces here are incredibly simple people. And you know who you are. They're all looking at me like, is it me? Is it me? Is he talking about me? No, Lori, I'm not talking about you. You know, you don't even know who Don Rickles is.
Do we go with the expected income or the current income?
Okay, well, that's the thing. It's on the current income, all right? It's on the current net operating income. But the thing, you'll see how games are played with these three variables. As an investor, you need to know the cap rate of the type of asset you're looking for. I'll show you what I mean. It's not controlled by mortals. So the broker can't come to you and say, well, this property is trading at a 6 cap. Yeah. Are you kidding me? This thing's a dog. No, this is not a 6 cap. The seller's trying to sell it as if it's a 6 cap. But we are investors. We know our market. And this property is not a 6 cap. The cap rate is not determined by mere mortals. It is determined by the markets. The markets will tell you what that property is, what that property is trading for. You can't make it up. It changes, and you'll see why in just a second. But you as an investor need to know it. You as an investor must know this number. If you call up a broker on a property and you ask him, what's the cap rate in this area? You've just lost all credibility. Because now he knows he can run circles around you. Because you, as an investor, don't even know what the value of the property is. If you say, I want to buy C-class property in Santa Barbara in this particular area, well, that has a cap rate that other investors are trading for in that area. You as an investor need to know what that is, or you're going to get one rough shot over. All right, let me give you an example. All right, I'm going to try to, on this particular graph, there are two things missing. I don't tell you where this location is, and I don't tell you what quality asset it is. Okay? Those are two factors that determine a cap rate. Good properties go for lower cap rates, risky properties go for higher cap rates. I'll show you what I mean in a moment. In this particular graph, whoops, I want to go this way. Do I have one of those pretty little,
Yes.
I do? Which one is it? Is it that
Green,
one?
it's
Oh, it's a green one?
Yeah.
green one, yeah.
Oh, that, look
There you
at
go.
that. Woo, that's a good one. Okay, look at here. In the year 2000, in this particular marketplace, properties of this type were trading at a 10.25 cap. Investors would buy property in this marketplace when the property was valued at 10.25. And you know about year 2000, the market was just starting to take off again. And look what happened. We all know 2000, 2006, we hit the top of the market, right? Look what happened to the cap rates. What we call this is compressed. They compressed. They got lower. But wait a minute, Charlie. Wouldn't that be that the property is getting less valuable if the cap rate goes down? No. We look at it as a quality of the asset, okay? So in this particular case, what happened was the market got stronger. Owning this property, the value of this property started to go up. And so by doing that, the cap rate came down. So remember, what we're trying to do here is we're trying to compare this investment to other investments. All right, so if it's down here at about a 6 cap, 6.5 cap, is it a risky, or is it a more valuable asset than if it was up at a 10.25 cap? Yes, it is more valuable because we're comparing it to other types of investments that are less risky. So if it's down low, if the cap rate is a low cap rate, it's comparable to like a government bond or a blue chip stock. If it's very high, like a double-digit cap rate, that's like a high-yield risk bond, high-yield junk bond. So just think about that as cap rates. Cap rates are going to fluctuate over time based upon what the market's doing. If we're dealing with low cap rates, we're talking about very nice properties, nice investments. Manhattan, what do you think the cap rate is in Manhattan? 2 to 3. Yeah. What do you think the cap rate is in Schenectady? 10. Yeah, high. That's how you have to think about it, okay? So, how do we know what the cap rate is? How do we find it? Hey, there are places on the on the internet where you can find out what the cap rates are. Here's one of them, apartmentpropertyvaluation.com. You put in the property address, the 5-digit zip, and it starts to calculate the cap rate for you. You can go to other places like CBRE. CBRE does a really great report twice a year. CBRE North American Cap Rate Survey. Folks, do the research. If you're trying to get into this business and find deals in your marketplace and you haven't done the research, a fool and his money. You want to finish the statement? Eric did it. Are soon parted. Do the work. All right, here it is. I told you the price. I told you the NOI. I told you the cap rate. This is the formula. And for those of you that are not analytical, for those of you like, oh, I'm not good at math, look at the way I look at this. This is a Picasso painting. This formula is a ballet of numbers. When one changes, the other ones move accordingly. It's all perfect. It works every single time. This is it. When you know this formula, when you commit it to memory, you will know exactly how this business operates. Okay? Let me give you some examples. This is how millionaires get made. Watch this. If I drive the net operating income up by $1 and my property is trading at a 10 cap, is that a good investment? Bad investment? Risky? Risky. If I push my NOI up by $1, I have just increased my family's net worth by $10. How does a Subway franchise do that? Remember I talked about forced appreciation? This is what I'm talking about. I forced the appreciation. I drove the NOI $1. The property's trading at a 10 cap. I'm now $10 richer. I can walk into the bank and borrow money off that $10. Look what happens when I change the cap rate, whoops, to a 6 cap, a nicer property. That same $1 has just grown to $16.67. That's my new net worth. And what happens when it becomes a 4 cap property, a really nice Class A property? What happens? My family's net worth just increased by $25. Are you getting it? Now, let me show you a real life application. Check this out. This is on one of my students, Jake Powers. He just bought a property about a month ago, 99 units out in Indianapolis. Okay, first deal he's ever done. Nice guy. Calls me up, we walked through the whole thing, I took him through the whole entire transaction, what to look for. He ends up owning 99 units. And this property is one of those value adds. The owner was tired, he wanted out, he was having tax problems and other properties he has, he needed the cash. It was so bad. And remember, what's my number one job? Keep you from getting screwed. Okay, so he calls me up and he says, okay, so this is what the seller wants. He says, he wants $25,000 earnest money, and he wants it hard on day one. I said, Jake, you can't do that. Hard on day one means that if Jake doesn't do the deal, the seller just walked off with $25,000. I said, Jake, you can't do this. This is your first deal. I said, you okay with losing $25,000? He was, no, not really. I said, then you can't do it that way. He said, let's he said, well, he's going to give me a personal guarantee that if it fails, he'll pay me back. I said, what, are you kidding me? The guy's losing all his properties for tax things. You think you're gonna see that $25,000? He goes, nah, what should I do? I said, well, you should do it this way. And he says, the guy won't, he won't